So in this chapter, we look at what are the factors that can be included in total cost when making global sourcing decisions. While designing global supply chain networks, we also should look at relevant uncertainties. We go over certain strategies that help to mitigate risk. We will also look at decision tree methodologies that can be used when we want to evaluate supply chain decisions under uncertainty. So globalization has many benefits, especially it helps to increase the revenues for a company. For example, big companies like Apple is always looking into markets outside US to increase their market share for iPhones and other products. And that's the reason they spend a lot of time finding ways to increase sales in countries like China, India, and so on. So although such globalization has many benefits, but it comes with some additional risk. Accenture, which is a consulting company, they conducted a survey to identify what are the sources of risk in global supply chains. And this survey was conducted in 2006. More than 1/3 of the executives that were involved in the survey identified top 3 risk factors to be natural disasters, volatility of fuel prices, and performance of supply chain partners. So in last few years, natural disasters have been in news, whether they are the floods in Thailand or earthquake in Japan, and also tsunami that started somewhere in Indonesia. These events for a global company always cause a lot of problems and disruptions, because a company which is getting their parts for the assembly of a product from places like Japan or Indonesia or Thailand obviously will be affected in a big way. Similarly, volatility of fuel prices, we have seen in 2008, the crude oil prices went as high as $140 and then dropped to about $40. This creates a lot of difficulties for companies that have global supply chains. For example, if you consider a company like Freeport McMoran, which trades with the symbol FCX. So this is a natural resource company, and they have mineral assets and oil and natural gas resources. So it's a global company with 5 primary divisions. They have North America copper mines, they have South America mining, Indonesia mining, Africa mining, and molybdenum mines. So if you look at its stock price over last few years, in fact last 10 years, you'll see there is a lot of fluctuation. So went up, and then from 60 it fell to below 10 during the previous recession, and then again rose to almost 60 and then gradually fell. So with that experience, what they try to do to reduce global risk and also changes in oil price from like 40 to 140. So they decided to buy some oil related resources so that when oil prices goes up, so they can reduce their overall risk of increased oil prices. As soon as they took that action to buy this oil company, oil prices started going down from 80, 90 to below 50. And with oil prices, its stock price also, you can see, started falling. And eventually they had to sell that at a loss to get out of that losing business. So sometimes a company may take actions thinking that they are guarding against uncertainties and risk. It might work, but it can also backfire, as it did in the case of Freeport McMoran. Similarly, performance of supply chain partners is another critical risk factor. When supply chain partners are scattered all over the globe, it creates a lot of challenges in coordination and other activities. Similarly, there are many other factors which also have a lot of impact on global supply chains. And so many global companies make use of offshoring to reduce cost, and especially if production activities can be carried out at places where labor cost is significantly down, that can help to reduce manufacturing cost significantly. And that's the reason we see so many companies get their manufacturing done at places like China and Mexico. So offshoring decisions are beneficial, but they can also fail. And two of the reasons are listed here. Focusing exclusively on unit cost rather than total cost. So there are various elements that are associated with the overall cost that should be taken into account rather than just focusing on the unit cost. So we will look at some examples. And the second reason quoted is ignoring critical risk factors. So we are going to look at some risk factors also. So note that when a company decides to go for offshoring or get their work done somewhere outside, so that also increases the length and duration of information, product and cash flows. Similarly, complexity and cost of managing supply chain, this also is significantly higher than anticipated. Some key elements of total cost recommended by some researchers are listed below. So if you look at supplier price, it may include costs from direct materials, direct labor, indirect labor, local taxes, manufacturing cost, etc. The total cost also is impacted by the terms that a company enters into while making offshoring decisions. Sometimes the terms may include volume discounts, etc. Delivery cost may include transportation related costs within the country or the cost associated with the packaging, the product or the material. Similarly, total cost may include inventory and warehousing, so which includes in-plant inventories and also includes handling cost, warehousing cost, supply chain inventories and supply chain warehousing costs. Cost of quality may include things like cost of inspection, cost of having appropriate measuring instruments or getting them calibrated, and if items are found out of spec, then this cost may also include the rework cost and so on. Similarly, total cost may include customer duties or value-added taxes or local tax incentives that companies might receive. Another cost element is cost of risk, procurement staff, broker fees, infrastructure, tooling and mold costs. And the last one is exchange rate trends and their impact on the cost. So although offshoring provides a lot of benefits in terms of getting things done at a lower cost, but it also poses a lot of challenges in terms of increasing risk. And therefore, risk management is a very important activity in global supply chains. So in the table below, various categories are listed and what are their drivers, that's also indicated. For example, risk drivers for disruptions include natural disasters like earthquakes or tsunami or floods. Another driver could be war. So whenever a country goes into war, it is a big threat to the supply chain. There is a risk of terrorism, labor disputes, especially like different countries may have different laws, and how to handle that may change from one country to other country. Or it might happen that a supplier may not be doing well and may go for bankruptcy, and that can cause a sudden disruption to the supply chain. So drivers for delays are high capacity utilization at supply source. So if capacity utilization rate at the supply source is quite high and if there is any breakdown, that will cause a lot of delays. Inflexibility of supply source, poor quality or yield at the supply source. So for example, if the yield is very poor, that is going to reduce productivity and lead to a lot of delays. So if there is an information infrastructure breakdown, that obviously can cause problems. Similarly, level of integration or extent of system being networked, that can also have a big impact on systems risk. Similarly, in global supply chains, because many partners are involved, there is always a forecast risk because of inaccurate forecasts due to long lead times. There could be impact of seasonality. Product variety can also lead to forecast risk. Short life cycles, small customer base, information distortion. So all these can cause forecast risk. In a global supply chain, when a company is working with so many different partners, So there's always risk associated with the intellectual property. Another risk is procurement risk. So when a company buys something from a supplier and when exchange rate changes, it goes up or down, so that can have a big impact on the cost. Similarly, if the price of inputs change, so again that will have a big impact on the cost of purchasing those items. If a large fraction of items are purchased from a single source, then that also could be very risky. And another driver for procurement risk is industry-wide capacity utilization. Similarly, there is a receivables risk due to number of customers or financial strength of the customers. So customers may not be able to pay on time, or maybe if they are going through bad times, there may be a lot of delay in paying back the money. There is a inventory risk in global supply chains. Sometimes a product may become obsolete because of various reasons. For example, if the company which is purchasing from a supplier makes a major design change and this information reaches supplier very late, and in the meanwhile suppliers have produced a lot of items with the old design, so those items either will have to be reworked or totally scrapped. Anything we keep in inventory obviously involves inventory holding cost. So it involves handling that material, moving that material from one place to other place. Product value can change. Demand and supply uncertainty can also have impact on inventory. There is also risk to capacity. So cost of capacity may change, and this risk is also driven by capacity flexibility, how flexible the capacity is. So at the time of designing global supply chains, to reduce supply chain risk, there are several strategies that may be adopted. But any strategy that we adopt obviously will come at a price. For example, when we increase capacity, that will also cause cost to increase. Therefore, to use any strategy, we should also make sure that we tailor it to be more effective. While increasing cost, one has to look at what kind of demand we have. So if it is a predictable demand, then it is important to focus on low cost, decentralized capacity. But when demand is unpredictable, then it will make more sense to build a centralized capacity and then increase decentralization as cost of capacity drops. Similarly, if one uses strategy of getting redundant suppliers, again that comes at a price, because having more suppliers will obviously increase cost, because as each supplier will be producing smaller portion, so they may not be able to benefit from economies of scale, and therefore the cost may go up. So tailored strategy in that case could be to use more redundant supply for high volume products and less redundancy for low volume products. And also centralize redundancy for low volume products in a few flexible suppliers. If the strategy is to increase responsiveness, then a tailored strategy would be to favor cost over responsiveness when dealing with commodity products and responsiveness over cost for short life cycle products. Increasing inventory level to meet demand obviously could be a good strategy, but that also will come at a cost, because with the higher inventory there could be a risk that a product becomes obsolete. So a tailored strategy will be to decentralize inventory of predictable, lower value products and centralize inventory of less predictable, higher value products. Another way to tackle supply chain risk in global supply chains is to have increased flexibility, and tailored strategy could be to favor cost over flexibility for predictable high volume products and favor flexibility for situations when we have unpredictable low volume products, and also centralize flexibility in few locations if it is expensive. Similarly, another good strategy could be to pool or aggregate demand and increase this, especially when unpredictability grows. Another one could be to increase source capability, and tailored strategy could be to prefer capability over cost when dealing with high value and high risk products, whereas favor cost over capability when we are dealing with low value commodity products. In later chapters, we look at these strategies in much greater detail. Flexibility plays a very important role in reducing the impact of risks and uncertainties that are associated with global supply chains. So there are three broad categories of flexibility that we come across. One is new product flexibility, which is ability to introduce new products into the market at a rapid rate. So for example, if you look at technology companies, they make use of a common architecture and product platforms to develop this ability. They are able to introduce new products at a very rapid rate. So a company like Samsung, they make use of common architecture and product platforms to come out with new TVs or new phones every year. And that is true for other companies like Apple or Microsoft. Second broad category is mix flexibility, which is ability to produce a wide variety of products within a short period of time. So companies use modular design and common components to achieve such a flexibility. And one good example is Zara. So they are able to provide trendy clothing with highly unpredictable demand. And the third category is volume flexibility, which is ability to operate profitably at different levels of output. So if we look at 2008, when we had previous recession, so most of the automotive companies had very difficult time due to inability or inflexibility in terms of volume. So what happens is if a business is not flexible in terms of volume, when economy goes down and demand also reduces because of that, but if a company continues to produce at the same rate, like let's say 200,000 cars every year, whereas demand has fell to only 50,000, so obviously those extra that are produced, they will be sitting as an inventory and their values might reduce significantly with time. So although companies make use of flexibility in some form to address global risks and uncertainties, but we also need to understand some other benefits and limitations. Suppose there is a company that sells 4 products. So if you look at the first network, which is a dedicated network, this hardly has any flexibility because each company produces only one product. So with dedicated network, what can happen is if demand becomes more than the capacity, then this plant cannot fulfill that extra demand. But if we have a fully flexible network where each plant is able to produce not one but all 4 different types of products, so this will be very beneficial if demand is unpredictable. So for example, if demand for the first product goes up and demand for second product goes down, so whatever extra capacity second plant has can be used for producing extra items of first type. But then this also increases the cost because now each plant has to be flexible enough to produce 4 different types of products. Now, one suggestion to reduce cost is to make use of chained network with one long chain. So what happens here is plant 1 is able to produce product 1 and product 2. Similarly, plant 2 is able to produce products 2 and 3 and so on. And researchers have shown that this type of network is more or less as efficient as a fully flexible network, but this can be achieved at a much lower cost. So this chaining strategy is quite useful in reducing the risk. One disadvantage which a chain network might have is when the chain becomes longer, like when you have many more plants and many more products, so the fixed cost of such a long chain could be very, very high. And in fact, with the use of shorter chains like this one can reduce that fixed cost. So what happens here is two plants are able to produce items 1 and 2, and plant 3 and 4 is able to produce items 3 and 4. So with demand uncertainty, longer chains pool available capacity. However, long chains may have higher fixed cost than multiple smaller chains. So in those situations, one may be able to use the last approach. And not only the cost, coordination also becomes more difficult in longer chains. At the time of designing global supply chains, various models can be used to evaluate a particular strategy, and discounted cash flow analysis is one such approach. So this is based on time value of the money, which means $1 today is worth more than $1 tomorrow. Because if I have $1 today, I could invest it, and which can grow to a higher value in future. So to do the calculations, we make use of discount factor, which is given by 1 divided by 1 plus k, where k is the rate of return. So for example, it could be 10% or 20% depending on the investment. And then we can calculate what is called as net present value, where C0, C1 up to Ct is stream of cash flows over T time periods. So once we do the calculation, we can compare net present value of different supply chain design options that a manager may have, and then the option with the highest net present value could be chosen because that will provide the greatest financial return. So let's look at one example which involves Trips Logistics, which is a third-party logistics company, and they have demand of 100,000 units. They need 1,000 square feet of space for every 1,000 units of demand. So revenue is $1.22 per unit of demand. They have to choose between two decisions. One is either sign a 3-year lease or obtain warehousing space on the spot market. The cost for 3-year lease is $1 per square feet, whereas spot market cost is about $1.20 per square feet. And K here is estimated to be 0.1 or 10%. So we can carry out discounted cash flow analysis using this data. If the manager decides not to go for the lease but to obtain warehouse space from the spot market, then the calculation for expected annual profit will be like this. So here we have two parts. One is the revenue and the second part is cost. So revenue minus cost will give us expected profit. So it comes to about $2,000. And then we can calculate net present value. So in time period 0, cash flow is $2,000, and time period 1, it is 2,000 divided by 1 plus k, and because k is 0.1, so we have 1.1 here, and so on. So using this we get 5,471. Similarly, we can do the calculation of NPV for lease situation. We have same revenue, whereas cost will change because now we are using $1. So total expected profit is about $22,000. And when we do a similar NPV calculation, we get 60,182. So we see there is a big difference between the two numbers. And clearly second choice is better because it provides a much higher net present value. So based on this, manager may go for signing a lease. So one thing to remember is this calculation totally ignores uncertainty in demand and price that might exist. And that's why it doesn't give us a full picture and only gives us a partial picture. So let's look at an example using decision trees where we incorporate uncertainties also into the calculations. So we will consider 3 warehouse leasing options. One is to get all warehousing space from the spot market as needed. Second decision could be to sign a 3-year lease for 100,000 square feet and get additional requirements from the spot market. For example, if the estimated demand is 100,000 and the actual demand turns out to be much higher, then that additional demand can be met with the help of spot market. And the third one is to sign a flexible lease to use between 60 and 100,000 square feet at the rate of $1 per square feet. But then there is an upfront payment of $10,000 and any additional requirement will be fulfilled from spot market. So we have data like this. So 1,000 square feet of warehouse space needed for 1,000 units of demand, and current demand is 100,000, and we consider binomial uncertainty where demand can go up by 20% with the probability of 0.5 or go down by 20% with the probability of 0.5. Lease price is $1 per square feet, spot price $1.20, and also spot prices can go up by 10% with the probability of 0.5, and they can go down by 10% with the probability of 0.5. Revenue is $1.22 and we are considering K equals 0.1. So first we'll look at spot price option, and we construct this decision tree starting from period 0 where demand is 100,000. So when you see 100 here, this is in thousands and the price is $1.20. Given the uncertainties, 4 things can happen from here. So one is demand can go up by 20%. So earlier it was 100, now it is 120,000. Similarly, price can go up by 10%. So 10% of 1.20 is 0.12, and when you add the 2 you get 2, 3 and 1. So that's what we see here, $1.32. Now second branch is where demand is up by 20%, so that's 120, but then price can reduce by 10%. So 120 minus 10% of 120 is 0.12. So we get 1.08. So that's what we see here. Similarly, in this branch, we have D equals 80 because we are assuming that the demand goes down by 20%. So 100 minus 20 is 80. And this one is where price is up by 10%. And this one is where price is down by 10%. So this way we have 4 options. And please note that the probability that demand increases by 20% is 0.5 and price increases by 10%. So that probability is also 0.5. So these together give us 0.25. So this is the number you see here. Similarly, once we go from period 1 to period 2, again for each option we have 4 new options. So first one where demand goes up by 20%. So 20% of 120 is 120 times 0.2. We add 120 and 24, we get 144. So that's the number you see. And similarly, 10% of 1.32 is 1.452. So this is rounded to 1.45. Similarly, for this node, we subtract from 1.32 minus 0.132. We get 1.188. So this is rounded to 1.19. Again, the probability of demand going up or down by 20% is 0.5, and the chance of price going up or down by 10% is also 0.5. So 0.5 times 0.5 is 0.25. So this is what we see elsewhere. So once the structure for decision tree is ready, we can do some calculation to find out how valuable this option is. Before we do the calculations, let me number each node so that it becomes easier to identify them. So overall there are 14 nodes. So let's do calculation for node 6. Profit at node 6 is given by revenue minus cost. 144,000 times 1.22 minus 144,000 times the cost is 1.45. We get negative 33,120. So this way we do calculation for each node from 6 to 14. So I'm going to write this down near the node. So this way we calculate profits in period 2 for nodes from 6 to 14. Now let's look at period 1. So I'm going to show calculation for node 2 here. We calculate expected profit at node 2 by taking weighted average, where weights are all these values here. 0.25 are the weights. What we do is we do 0.25 multiplied by negative 33,120 plus 0.25 times 4320 and so on. So this gives us negative 12,000. And then we calculate present value of this expected profit, where we make use of the K or discount factor. So this profit in period 1 is going to be, so now we can calculate profit at node 2. So we have demand for 120,000 items. So that's the revenue minus 120,000 times 1.32 and then plus the number that we calculated just now. So negative 10,909. So this gives us negative 22,909. So similarly we can calculate profit at node 3, 4 and 5. So once we complete calculations for period 1, now we can do the calculations for period 0 using a similar approach. So at node 1, we calculate expected profit by using the weighted average formula. 0.25 times negative 22,909 plus 0.25 times 32,073 and so on. We get 3,818. And present value of this expected profit equals 3818 over 1.1, which is 3471, and we can calculate profit accordingly. So now we have 100,000 items, so revenue will be minus the cost. So price here is 1.2 plus 3471 that we got. So this will give us 5471. So we can say net present value in this case is 5471. So this was a spot price option. Let's write this next to the decision. So let's do the calculation at node 6. So demand at node 6 is 144,000 units. Out of 144,000, only 100,000 is available, and remaining 44,000 will have to be purchased from the spot market. But if the demand is less than 100,000, for example, in these situations like node 10 or node 11, so there a manager has to pay the full price. So profit equals revenue minus cost, and where revenue is going to be 144,000 times 1.22, and the cost is going to be 100,000 times 1, and then for the remaining 44,000 times whatever price we have. So in this case it is 1.45. So this gives us So we deduct this upfront payment of $10,000. So minus 10,000 is 46,545. So when we account for all these uncertainties, obviously option 3 seems to be the best one. Let's look at another example where there's a solar company called D Solar, and this is a German company, and the decision they are facing is whether to onshore or offshore. So the current demand is about 100,000 panels per year, and each one sells for about 70 pounds. There is a chance of demand increase by 20%, and the probability is 80% of going as high as 20%, but it can also decrease by 20%, and that probability is 0.2. So the question is whether to build a plant in Europe or China with a rated capacity of 120,000 panels. So if one goes for European plant, so they have a fixed cost of 1 million euros per year, and the variable cost is 40 euros per panel. At the Chinese plant, the fixed cost is going to be 8 million yuan per year, and variable cost will be about 340 yuan per panel. So in period 1, the demand is likely to be 112,000. Exchange rate in period 1 is expected to be 8.64 yuan per euro, whereas in period 2 demand is expected to be 125,440 with exchange rate of 8.2944 yuan per euro. If they make a European plant, so it is likely to have a greater flexibility, and they'll be able to produce between 60,000 and 150,000 panels. But Chinese plant will have limited volume flexibility, because they will be able to produce between 100,000 and 130,000 panels. The range is lower than what can be done at European plant. Chinese plant will have a variable cost for 100,000 panels, and they will lose sales if demand increases above 130,000. And currently exchange rate is 9 yuan per euro, and this is expected to rise by 10% with a probability of 0.7 and drop by 10% with a probability of 0.3. And this sourcing decision is for next 3 years, and discount rate K is 0.1 or 10%. So if we do discounted cash flow analysis, so you can say in European plant during period 0, the profits are going to be demand, which is 100,000, times revenue of 70 euros per panel, minus the fixed cost. So remember, this is fixed cost, and this represents variable cost. So we get a profit of about 2 million euros in period 0. Similarly, we can calculate profits for period 1 and 2. So the expected profit from onshoring, so that is having a plant in Europe, so we get slightly above 6.4 million pounds using this analysis if we go for European plant, and a similar analysis for Chinese plant yields above 6.8 million euros. So please note that when calculating numbers for Chinese plant, we have to convert yuan to pounds. So for that we have to use appropriate exchange rates. So clearly going for a Chinese plant looks to be a better option, but this analysis does not include the uncertainties. So let's do that by using decision tree analysis. So in period 0, we start with demand of 100,000 and exchange rate is 9. So as we know, demand can either increase or decrease by 20%. So if it increases by 20%, it becomes 120. And if it decreases by 20%, it becomes 80. Similarly, exchange rate can increase or decrease by 10%. So if it increases, it becomes 9.9. But if the exchange rate falls by 10%, it becomes 8.1. So probability of this happening is 0.8 times 0.3. Similarly, probability that demand goes up by 20% is 0.8, and probability that exchange rate goes to 8.1 is 70%. So let's number all the nodes and do calculations to see what we get. So one thing to remember here is, even though demand is for 144,000 panels, but at this plant the maximum we can make is 130,000. So revenue is going to be 130,000 times 70 and minus fixed cost 8 million yuan, and we divide this by 10.89 to convert to euros, and similarly variable cost will be 130,000 times 340 over 10.89. So in terms of euros we get So while doing this analysis, we see that we not only take into account variability in demand, but we also take into account variability in exchange rates. And we find that because onshore plant provides a lot of flexibility, we have better returns if we go for this decision. So note that when we did DCF analysis, which did not take into account uncertainties in demand and exchange rates, it gave a better result for offshore decision. But when we take into account uncertainties in demand and exchange rates, we find that it will be more profitable to go for European plant in this example. So using these examples, you can see how uncertainties can be incorporated in the analysis, and we can make a more informed and more profitable decision with the help of such analysis.